Okay, we're going to be watching shares of Stelco at the open today. The Canadian steelmaker being acquired by U.S. steel giant Cleveland-Cliffs in a deal worth more than $3.5 billion Canadian. Stelco shareholders will get cash and stock worth about $70. That's a more than 85% premium from the closing price on Friday of last week. You'll recall the current version of Stelco has been public for more than a half dozen years. The company's history, though, goes back more than 100 years. It was in the mid-2000s when Stelco fell on hard times, filed for bankruptcy. U.S. Steel ended up buying the business and changing the name to U.S. Steel Canada. It later took Stelco's best contracts, basically abandoned what was left of the company. But a noted turnaround artist, Alan Kestenbaum, acquired the assets out of bankruptcy, helped bring Stelco back to life. He's a big shareholder, so this becomes a big payday for him. Fairfax Financial, another big investor in Stelco. And for Cleveland-Cliffs, this is its first major move after losing out in its bid to buy U.S. Steel last year. All these steel players have very common threads. U.S. Steel, of course, reached a deal with Nippon Steel out of Japan. I want to bring back John Goldsmith, who's been joining us this morning from Montrusco Bolton to talk about the mood of the markets, to see some deal activity in the steel sector. What's your take on that?
Look, I think part of it might have to do with, the likelihood that with a Trump presidency, there's going to be more reshoring there. So, that could definitely help the U.S. steel makers. I'm not terribly surprised. I think the deal in and of itself is great. Stelco has, for the last couple of years, traded a massive discount to U.S. players. So you mentioned Cleveland, U.S. Steel, Nucor, Steel Dynamics. They're trading literally twice the multiple. So this multiple that ends up getting paid is roughly 4.8 times the last 12 months trailing EBITDA, which is kind of in line with what, Cleveland is trading at right now. So I think they played, a very nice price for it, and you'll see with the premium that just goes through.
Well, let's stay on the theme of valuations, because I wanted to ask you about your view on the Canadian stock market. Yes, we've seen U.S. record highs, but now the Canadian stock market is at an all-time high. And when you look at some of the strategies that are pulled by Bloomberg on what could happen for the TSX over the next 12 months, some would not be surprised to see better performance for the Canadian market versus the U.S. market. Part of that is based on the valuations of Canadian equities. How do you feel about the Canadian stock market right now?
So I feel very positive on the Canadian stock market, primarily because of, over the next couple of years, with regards to the whole energy transition theme, Canada, there's not a lot of places in the world where you can play public equity markets and commodities that are liquid, and companies that have basically found a newfound religion, if you will, with regards to reallocating cash back to shareholders in the form of dividend share buybacks and debt repurchases. So, that is a really good backdrop. But with regards to the valuation point in and of itself, Canada always trades at a discount to the U.S. I mean, pretty much every country in the world trades at a discount to the U.S. And the discount that Canada trades at today is not really that significantly greater than what it has been over the last 10 years. It's not like some 2 or 3 sigma or standard deviation event. So I think really it'll come down to, once again, Canadian companies being able to throw off better earnings and cash flow. And once again, we talked about the concentration in the U.S. If the Mag 6 or 7 end up hitting a little bit of an air pocket and then relying on the remaining 494 companies in the U.S. to kind of pull the weight, I think that's the interesting trade for Canada as opposed to the U.S.
The other big theme in Canada, obviously, is what's happening on our housing market. This week, we'll be watching what is happening on the inflation front. We'll get some data tomorrow. We'll see how that impacts the thinking around interest rates. But as an investor, you have been watching some of the equities associated with the housing play. Main Street Equity is one example, for example, of a company that you like right now. How come?
So, the big issue in Canada is, if you take a look at where's some of the biggest issues with regards to housing affordability worldwide, Canada is, probably, ground zero for it. Whether it's being exacerbated because of the rates, the lack of building, the increase in immigration. But the beauty of Main Street Equity, it's about $1.5 billion market cap. It's a multi-res. It's about 19,000 units, primarily in the Alberta, Saskatchewan, Manitoba geographies, with also a decent chunk in BC. These are areas, especially as it pertains to Alberta and Saskatchewan, that are not rent controlled. The other thing that makes Main Street Equity really interesting is the fact that, as opposed to a lot of the other multi-res units, they don't pay a dividend, which means that they're not forced to pay out 70, 80, 90% of their cash flow in the form of dividends and then having to, reshore the balance sheet to go do deals. All that cash flow basically comes to them, and they can do that then to do deals, and they can source deals better than anybody else in the geographies that they're in because they're extremely well plugged in.
And then just on the interest rate front, because I think everybody in the housing market's watching that very closely, and we do have that inflation data tomorrow. What do you think plays out in Canada for the rest of the year? What's your thinking?
There's probably another 2 cuts. So I think July, so the next couple of next week or so, you're going to get another cut in Canada, and then they're most likely going to have another one. I'm actually very positively surprised by how strong the Canadian dollar is held up versus the greenback. You would have thought that the Canada moves, way before the U.S., you'd start to see a big weakening, and I think a lot of that has to do with how people or traders are positioning. Canada maybe, or Europe and Japan, they're maybe taking the lead right now, but eventually, growth in the U.S. will slow down a little bit. At that point in time, that relative trade makes the Canadian currencies or non-U.S. currencies a bit more attractive. But getting back to the housing question, I think once again, what the government wants to avoid is the reset of rates in 2025, because that's going to be 5 years post the trough in rates. And that could have a major, negative impact in terms of economic growth. So if you can get a little bit of support from that side for the housing, because Canada is extremely levered to housing, I think that would be a very good backdrop. I think it's probably already priced in the market for 3 cuts this year. I think the question is next year, how aggressively the Bank of Canada is going to have to cut. And is it 3 or 4 rates, for 3 or 4 cuts? I think that's the big question there. But 3 or 4, you're looking close to another 100 basis points next year off of 75 bips this year. It's close to 2% off. I think that will probably do a pretty good job of dampening the negative effect of the rise in rates over the last 5 years.
Well, it has become a big summer event. Amazon, with its 10th annual Prime Day underway in basically 24 countries, including Canada, and it is expected that we'll see a new record in terms of at least the U.S. shopping numbers for the company, more than $14 billion expected in sales over the 2-day period, which would be sharply up from last year. We spoke with Beryl Tomei, who is Amazon's Vice President of Last Mile Delivery and Technology, to talk a little bit more about preparing for the 2 busy days. And she talked to us a little bit more about the facility she's operating from near Seattle.
I'm at one of our buildings near Seattle. We're ready to go for Prime Day. It is our 10th Prime Day, and I was talking to some of our employees this morning. Everyone's excited. Everyone's ready to go. This event is all about celebrating the value that our over 200 million Prime members across the world get. We have millions of deals available, dropping as often as every 5 minutes through select periods. Customers can shop from over 35 product categories like apparel, home, kitchen, beauty, more. And we think it's going to be a great opportunity for folks to get a head start on back to school shopping with deals up to 50% off and even more.
Tell us a little bit more about the evolution of Prime Day as well. As I mentioned, summer traditionally a bit of a sleepier time. Prime Day has really changed the story of that, especially with the online sales numbers over the years. Can you tell us a little bit about the evolution of it over the past decade?
We've invested quite a bit in Prime Day. We've added more countries. We've added more selection. One area customers can shop from is from small business sellers. In fact, over 60% of our sales come from independent sellers. We've also invested quite a bit on the convenience aspect in terms of speed of delivery. In Canada, last year we hit some new records. There were 20 million items available for free Prime shipping, and millions of those shipped with same day or next day delivery. Customers have had a really great response to that, and we're excited to continue our investments there.
And the fact that the Prime program itself, you talked about how large it is now. Maybe you can walk us through some of the numbers behind the size and scale of Prime and why Amazon has seen it as, in many ways, a competitive advantage for the company.
For us, our focus is on our customers, and last year we saw customers save over $2.5 billion globally from the deals that they purchased through Prime Day. We're very excited about this year as well. And one new thing customers will notice this year is in their packaging. We've removed nearly all of the plastic air pillows from our packaging and replaced it with 100% recyclable filler, and that's part of our sustainability commitment.
Okay, so Amazon appears primed to capture shoppers over the next couple of days. Of course, this has become such a big online event that some of the other retail players are getting into the mix with their own events around this time this week. How do you stay competitive? How do you keep that competitive advantage when obviously a lot of companies around the world are looking to draw shoppers towards their various platforms?
Our attention is on our customers, and one way we've also done that is through our investments in AI and technology. So when you come to our store, there's a personalized shopping experience. We recently added summarized customer reviews through the use of a large language model. And of course, we have our robotics sites. In fact, we just opened another robotics facility in Calgary this year, where robotics work collaboratively with our employees to create a safer and more ergonomic workplace, and also help items move faster through a building, which delights customers in turn.
All right, and speaking of Canada, we should let our audience know you're a University of Waterloo graduate yourself. And as I mentioned with your title, Vice President of Last Mile Delivery, sometimes people place an order on Amazon and it seems like lickety-split you can receive those packages at your front door. Can you just talk to us about the evolution of getting things to people that much faster and how that has played out even over this 10 years of Prime Day?
Yes, and I am a proud U Waterloo grad and Canadian, so very excited to be here for that reason too. One way we're able to deliver quickly to customers is through our Delivery Service Partner Program. This is a program we created a few years ago where hands-on entrepreneurs can create their own business delivering for Amazon. We have over 3,500 of them globally across our network, and they hire and manage their teams, manage their operations. We in turn provide them with the training, technology, and infrastructure to be successful, and they're a huge part of what will make Prime Day a success.
We're in the thick of U.S. bank earnings season. A lot of the big lenders have posted stronger than expected results on the back of rebounding investment banking revenue. There's a look at U.S. Bancorp today, one of the regional players. Our guest says rate cuts from the Fed would be likely to lift the bank stocks further this year. We're joined by James Demmer, Chief Investment Officer at Main Street Research. Thanks very much indeed for joining us. If you could generalize, James, what lesson have you been learning, or what pattern have you seen in bank earnings so far?
It's a pleasure to be here. Good to see you again. I think what we've learned from bank earnings so far is it's been a bit of a mixed bag. The large, big banks with diversified business models have been killing it, right? Better than expected earnings, particularly like at Goldman Sachs or JP Morgan. And that speaks to, that other division that's not lending or net interest income. That is the trading and investment banking. And I'm not surprised by that. That's kind of what you will see in the beginning of the new bull market for the financials, is what I would call that. So this is an exciting period, but you want to be careful, be a stock picker. I think the results show that. And I think that you can also see some of the regionals, like you just mentioned, US Bancorp, and some of those starting to act better, even if the earnings aren't there. And I think that's investors saying, yes, valuations are cheap enough, and the Fed's lowering rates, or the idea that they might soon, which we agree with, is going to be the catalyst for the new bull market in financials.
And we're seeing a mixed reaction to regional bank earnings today. Investors seem happy with the report from US Bancorp and Citizens Financial, but a couple of others, including First Horizon, the one TD Bank was going to buy, not getting such a good reaction.
Yeah, and I think, again, you want to be a stock picker here. Those that really rely on that net interest income are probably not going to be the first winners, let's say, in my theory, our theory of the new financial bull market, because they're going to really need that the Fed to actually already have lowered the rates for that to come through on the bottom line. So again, be a very careful stock selector. Go with the business models where they're not just lending and they're not just depending on net interest income. Go with those that have revenue sources outside. That's not to say that if you own, let's say, some of those that are more focused on lending, that they won't do well a quarter or two from now, but you're going to have to be a patient investor. And as you know, investors are notoriously not very patient.
No, that's right. JP Morgan is among your favorite in the US, big US banks. It has been hitting record highs, but you see more upside.
Yeah, we do. And it's interesting. A lot of investors say, "Oh gosh, they hit new highs. The train's left the station. It's too late." Mm-hmm. And I would really argue against that because it checks all the boxes. Not only do they have those diversified business like investment banking and trading, and they're a global powerhouse and a great strong balance sheet, but it's trading at 12 times earnings. I mean, historically cheap. So that train is still waiting for passengers, and we think JP Morgan is a wonderful position here as this new financial sector bull market starts to blossom.
And just remind us, I know it's well known, but why are lower interest rates typically good for banks?
Well, they're charging us an interest and they're borrowing money. So when rates go down, they're borrowing it less and they're still most likely charging us the same. So their margins expand, right? So that's why it's been so difficult for these businesses for the last few years to get out of their own way because rates have been going up. Now we envision, which is often the case with new bull markets and business cycles, which we're in, once that inflation's gone, rates start to go down, and wow, the wind is at the back of the big banks and even the smaller ones. What's interesting is the Russell 2000 doing well. Keep in mind, 40% of the Russell 2000 is regional banks. So that tells you investors are already anticipating that the Fed's going to cut.
So the Russell 2000, the well-known small stock index, you say 40% of it, excuse me, is second-tier banks?
It sure is. It's not a known fact out there, but boy, if you buy the Russell 2000, you better be liking those regionals.
You reckon that the financials generally are trading at near historically low price earnings multiples?
Yeah, they've just been, in all the AI hype, and which has been wonderful. The financials have been absolutely ignored unless they're in an index. And I think I would even suggest, and I think recently you're seeing this. Not only have they been ignored and they're trading at historically cheap multiples, there's a lot of short positions in the financial stocks. People just thinking, gosh, they're not going to get out of their own way. And I think one of the reasons you're seeing some of them catapult, like Regions Financial in the last few weeks, is that those short positions are starting to cover. I mean, they have to buy the stock back, which is pushing these stocks up even more. I think you're going to see more short covering, which is fuel, right, for these financials over the next few quarters.
And I know it's hard to generalize, but among the regional banks, have concerns over asset quality dissipated a bit? For example, their exposure to commercial real estate?
Well, I'm not sure. I'd say that maybe the best thing about that is it's already in the price. The ones that have the really significant exposure, I'm not sure I'd be excited about owning those. I think investors want to stick to, maybe those that don't have significant exposure to commercial, because, maybe that doesn't get worse. But I don't see that getting better anytime soon. And boy, we have so many choices of very low valuation regionals and big banks. I would just, stay away from those.
We just saw a takeover in the Saskatchewan uranium patch, or at least the deal is in the works. Paladin Energy of Australia has made a $1.1 billion offer to buy fission uranium. It's all about geography. If this deal goes through, it'll give Paladin operational control of an advanced mining project in Saskatchewan's legendary Athabasca Basin, which of course is loaded with beautiful high-grade uranium. I sound like former President Trump there. Beautiful uranium. Anyway, Paladin CEO Ian Purdy joins us now. And he says ultimately, Paladin could be the world's third biggest uranium producer after only Kazatomprom and Cameco. He joins us now. Great to see you.
Thanks, Andy. Yes, we're very pleased to be here, and we're very pleased with the opportunity to be part of the Canadian uranium mining industry.
What are you buying then? So Fission, what is their project?
The PLS project in Athabasca is one of the best projects in the world. very high grade, very simple conventional mining, and a great opportunity to establish a sizable uranium production base right here in Athabasca. It's very complementary to the rest of our global portfolio. We've got a terrific mine in Namibia, which is up and running and producing 4.5 million pounds per annum, moving to 6 million pounds.
And that's a lot of uranium.
When we add the Langer Heinrich production with the fission production, we see the opportunity to produce 15 million pounds per annum by the end of this decade.
And you think that would be maybe 10% of world uranium production?
Yes, it will be 10%. We'll be one of the major producers in the world. There's very few of us. You have Cameco, a wonderful Canadian company. As you mentioned, you have the Kazakhstan producer. And then we would be the next largest listed uranium company in the whole world.
And of course, strategically, it's interesting. North America, we want to secure, or the US wants to secure uranium from friendly sources, and Canada counts.
Canada's a fantastic jurisdiction, very close to the largest nuclear fleet in the world in the US. Also some terrific opportunities for customers here in Canada. We think Canadian ore and Canadian uranium is going to be strategically important to not only our customers in the US, but also our customers in Europe.
The deal is going to be reviewed, and of course, uranium is a sensitive area. The government has long taken a long, hard look at takeovers of uranium companies, and you do have a Chinese shareholder in Paladin. So could that complicate things for you?
Andy, we actually have a Chinese shareholder in Fission, the target company.
Oh, I'm sorry, I beg your pardon. Okay.
No, and so part of this deal is we will be diluting the ownership of the Chinese shareholder, and also removing some Chinese control from Fission Uranium Corp. So I had the pleasure of meeting with government officials earlier in the week. I explained the benefits of the deal, and the reception was very good, and we're very respectful of the process, and we'll cooperate any way we can.
That's interesting. I was under the impression that Paladin, you had a major Chinese partner, but it's Fission, right?
We're ASX listed on the ASX 100. Independently owned, independent board, independent chairman, and independent shareholders.
So you are confident? I mean, this thing hasn't gone to a security review, or what's the state of it right now in Ottawa?
We've received our competition approval this week, and we're awaiting the Investment Canada review process to be completed, at which case we'll move forward with the transaction.
How much roughly would it cost to build this fission mine if you were to go ahead?
The estimate is $1.2 billion Canadian, which would require to be spent in 27 and 28. For us, we're very comfortable with that figure. We've got terrific cash flows coming out of Langer Heinrich over the next few years. And obviously, being one of the largest companies in the world, we have access to all sorts of funding with deep relationships with debt providers.
Would you do an equity issue, do you think, to try to help pay for this?
We don't think we'll have to. Obviously, we're in a very, very strong uranium market.
Yeah.
We've made our first customer shipment out of Langer Heinrich. We've just received our first cash flows today, and there's plenty more to come. So with our cash flows and with our debt relationships, we think we're well covered for the funding.
And what about Namibia? Is it one of these big open pit, low grade mines?
Yeah, it's a large-scale mine, relatively low grade, especially compared to the Athabasca and PLS, but quite a simple mine, very well established and very reliable, big scale, and very good mining jurisdiction in Namibia.
And can you remind us, does Australia produce much uranium these days?
We do out of a copper mine, the BHP copper mine in Olympic Dam.
Okay.
They produce about 10 million tonnes of 10 million pounds of uranium as a byproduct. And then there's another small producer starting up in Australia as well.
Right. And of course, Australia has to make this tough decision. Are they going to build a nuclear plant? They never had one before.
Yes, there is a debate at the moment. It's across the world, we're seeing a lot of countries assess the benefits of nuclear energy as a carbon-free baseload energy source, which is very complementary to renewables. And we're pleased to see the political debate across the world. Our customers are in the US, our customers are in Europe, and we see lots of demand for uranium going forward.
How do you sell the uranium? Is it a one-on-one deal between you and the utility, or is there a third party, or how does that work?
It's a one-on-one deal. It's a bilateral contract between us and the major utilities. And you form a very close relationship. It's quite a small industry.
Yeah.
And the utilities like to deal with parties they know and trust. And fortunately, we've managed to establish those relationships, and we have great customers all over the world.
So the futures market in uranium is just very nascent, very small right now?
It is. It's a small market which is primarily driven by fundamental supply and demand. The financial players don't play as large a role as you see in other commodities. But we've got great customers, and we look forward to bringing them to support the PLS project in Athabasca.
And what about the Sprott Physical Uranium Trust that launched a few years ago? Did that really change the game in uranium by attracting new investors to the space?
Sprott did a wonderful job a couple of years ago. They really shone the light on the lack of liquidity and the limited stockpiles in the uranium market. They were very active a couple of years ago, and they fundamentally changed the dynamic in the market.
All right, well, let's get to one of the big stories we are tracking this morning tied to Canada's economy. We just got an update on the retail sales story across this country, and some early numbers for June are continuing to show softness. The receipts for retailers, at least the preliminary ones that were shared from Stats Canada, showed a decline of around 0.3% in that month, and that came after some May data, which showed a drop of around 0.8% in that month. That was below the expectations, according to a Bloomberg survey. And so ultimately, we've had a pretty weak first half of the year for retail sales in this country. I want to bring in Don Desjardins, Chief Economist at Deloitte Canada, for some more perspective on what's going on. Great to see you. So earlier this week, we saw some inflation numbers that were encouraging for anyone who wants, to see interest rate cuts. And I think one of the factors behind that inflation trend is consumers feel somewhat stretched right now. Maybe they're starting to push back a little bit on higher prices. What did you see in this retail sales data today?
Well, it certainly is a pretty sharp decline. And as you say, it's being continued into June. So we are definitely seeing consumers react to the fact that they have gone through a period of high inflation. Now that's coming down. And the bite from high interest rates. And this also echoed what we saw in the Bank of Canada survey earlier this week. They talked to consumers and they said, yes, we are saving more and we are putting off big purchases. So I think it all kind of works hand in hand.
It looks like with some of this data, things like discretionary spending are being impacted. Might be a new couch, or maybe electronics, maybe in some cases car purchases. So the wants versus the needs are an area where we're starting to see a bit of a pullback.
Yes, and that too was what consumers said, like essentials. And of course, with a lot of newcomers to Canada, the essentials, people are buying those to set up. But it is, as you say, the discretionary part where people are saying, maybe I should stow a little bit away. We know that mortgage rates for many mortgage holders are going to be refining at much higher rates.
Yeah. And that gets us back to this interest rate story. We already saw the Bank of Canada make headlines around the world with its recent pivot, and they cut interest rates by a modest amount compared to what we've seen on the increase over the last couple of years, but they cut them by 25 basis points last month. We've got a meeting next week, and the Bloomberg data would suggest in the markets right now, there's a pretty overwhelming number of participants who think they're going to cut again. Do you think they might cut again next week?
Well, we didn't. We thought they were going to hold off, but certainly the data that we've seen suggests that they have the opportunity here. I think that when we look at all of the list of things they said they wanted to see to move forward, that list, they've been able to tick a lot of those items off, whether it's inflation expectations. Again, that business survey showed that business inflation expectations have come down, and consumers, while they're still saying they think inflation will be about 4% over the next year, that's down from 5%. So we're seeing all these things move in the right direction for the Bank of Canada.
And so there's, I guess, the way the Bank of Canada explained it, I guess if these trends continue, you might be more likely to see more rate cuts. But if things are progressing at a reasonable pace, we might see sort of a steady pace on the declines, because even the U.S. hasn't even entered a rate-cutting cycle yet. So how would you characterize where the economy could be going? Like a lot of people talk about soft landings. And what are the caveats to watch? Like I would think if people are being more cautious in spending, obviously whether you've got a job or not is important. And our unemployment rate is now north of 6%.
Absolutely. I mean, we haven't seen massive job cuts per se. It's just that our population is growing so rapidly, employment isn't keeping up. But we have seen softness, and I think that that is the key. You know, if we see the labor market deteriorate, that is going to be very difficult for many households. You know, we think about the CPI data and seeing rents rise 8.8%. Yeah, it's lower than the 9% a couple months ago, but it's still. So that's a big stress for workers.
Yeah.
And if we do start to see the labor market capitulate, then I think we could be in for a really rocky road. Now, we don't think that's the case. The survey that the bank conducted said, yes, employers are stepping back from hiring, but they're not cutting. They didn't say they were intending to cut.